Philippines stands at a perfect policy crossroads. Weak 2025 growth, a pivotal Fed meeting, and the Bangko Sentral deciding on its key rate in 3 weeks. With us now live from Hong Kong, Citigroup Global Markets Head of Emerging Market Economics, Johanna Chua. Jo, good to see you and welcome back to the program.
Hi, Kathy. Nice to see you.
Okay, so what do you think the tone of discussions are like as the FOMC meets behind closed doors with Trump hot on the heels as Powell goes into the final stretch of his chairship?
Well, as you said, Kathy, the market is overwhelmingly expecting that there's going to be no change. So I think the actual action, given all the data that we've had, and we've already had 3 consecutive cuts coming out of the Fed, we've seen lower unemployment rate, we've got pretty low jobless claims, we've got pretty solid consumption. So I think the details on the data going into this meeting, notwithstanding inflation being somewhat a little bit softer, probably the path of least resistance is just to be on hold. But I guess, like you said, the key question is really what will be Powell signaling in terms of further policy action. And right now, our base case is, although Powell will be encouraged that unemployment rate fell to about 4.4%, we still think he's going to indicate a meeting by meeting approach, and therefore will still keep the option of further rate cuts alive. And the reason why we think that is, if you look at the dual mandate of the Fed, even though unemployment rate surprisingly went off a little bit and there was some backward revision, the monthly run rate of non-farm payroll is still relatively low. And not to mention, we're still running at about 50K a month. And then usually we have these big swings and downward revisions as well. So I think there's still a risk that the labor market will continue to weaken, notwithstanding the pretty low unemployment rate. And, again, I think the other issue is that inflation at the moment doesn't seem to be a big concern. As I mentioned to you, some of the data coming out of the US, at the margin, core PCE is kind of running at about 2.8%. So it's a little bit lower than what the standard economic projections was that the last time we got out of Fed. But, I think that's why inflation's not a big issue. And so it's all really about labor market.
That meeting by meeting approach, Joe, how do you think the Fed's decision in 24 hours is going to influence the Bangko Sentral and how it decides on February 19th?
So at the moment, we actually think the Bangko Sentral is going to be cutting rates. And the reason why is notwithstanding the hawkish cut that we had in December, it's really all about the economic data coming out of the Philippines. And look, we've got GDP numbers coming out tomorrow. And our forecast, we are actually below consensus on our real GDP growth forecast. We think the economy is going to even slow further from 4% in the previous quarter to 3.4%. So we are actually below consensus on our GDP growth forecast for 4Q. And the real issue is, this whole kind of ramification post the flood control scandal. Right now, when you look at government spending, it's still very weak. And private sector sentiment is still very weak. You look at confidence indicators, etc. So we think that if BSP is really looking at, the totality of the fact that inflation pressure is not really a concern and growth continues to be well below potential, we still think they will cut. Now, it helps also, maybe it helps at the margin that because of all the noise coming out of the US lately, not just as what you mentioned, the Fed independence concern, or even the noise out of the Greenland issue driving diversification, we've also had quite a bit of a soft dollar. Right. So to the extent that not that, BSP necessarily looks at peso, but to the extent that we don't have to worry so much about policy action influencing too much volatility on FX at this juncture, with the dollar being softer now, I think that will also give BSP to cut rates.
Well, let me pick up on that softer dollar, Joe, with the Fed where it is now, and we're talking interest rate differentials here because we're all not expecting the Fed to move. How much wiggle room does the Bangko Sentral really have to cut rates without triggering the renewed pressure on the peso?
Right. So we actually think that right now our base case is, for now, we think this is the last cut. And then from here on, it will be much more data dependent. Now, if the economy doesn't rebound further, there's still a possibility of an extra cut to 4%. But our baseline is terminal rate is at 4.25%. And at the moment, when we think about rate differential with the Fed, again, given where we are in the inflation cycle, usually Philippines really worries a lot about FX to the extent that it provides a lot of exchange rate pass-through risks on inflation. And at the moment, although inflation is, moving higher, if growth remains weak and underlying core remains weak, I don't think that will deter BSP from cutting further. And anyway, at the moment, although the Fed is pausing, the market is still pricing in, a little bit less than 2 cuts. So the market is still pricing 2 cuts. And in fact, we still expect, notwithstanding the data, we still think the market is too complacent, that the risk is that the Fed could actually cut more. So it may not be right now, and you don't really need the BSP and the Fed to be completely in sync. I think the market pricing in further softness, in a further room for Fed easing, I think still gives BSP leeway. But like I said, we're
Okay.
almost at the end. We're almost at the end of the road already.
Yeah, but there's got to be a sweet spot for the peso when you think about balancing imported inflation risks with the need to keep exports and the BPOs competitive. So how does that inform your BSP call beyond the meeting in February?
Look, at the moment, in fact, I mean, right now the peso has actually peso is being helped by the fact that the global dollar environment has been a little bit softer. But when we look at the underlying fundamentals in the economy, you look at the basic balance, you look at the growth trajectory, we still are of the view that, once we get past this big adjustment in the dollar, the peso could still gradually swing weaker and we could still test above 60 level. Now, to what extent is that going to deter BSP? I mean, like I said, BSP is really about inflation and inflation targeting. And right now, if the demand is still weak, then I don't think we worry so much about inflation. It's just that we're getting closer to kind of neutral levels, and I don't know if there's a lot of appetite to go, well below neutral, because I think inflation has bottomed. And the other thing we need to watch in Philippines is, as you know, oil prices have stayed a little bit sticky. We're still in the high 60s on Brent crude. Of course, we've got geopolitical risk, but part of that is also driven by the cold spell going on in North America that is driving up gas prices. So I think we really need to watch commodity, obviously, rice and energy and what the transmission of pass-through on FX. But at this juncture, I don't think it's a big issue at the moment for the BSP that will deter them to cut. And right now, on the overall growth, the problem with growth is not so much competitiveness of BPO. The problem is really all the ramification of the latest kind of what's happened on the corruption scandal, on government spending and private sector investor sentiment. That's not something that peso can solve.
Do we need to take a look at China, given your work on supply chain reconfiguration and the role of China's demand for the region? Do you think China's still the swing factor for your ASEAN growth distribution? Or do you think those domestic drivers, especially here in the Philippines, have become more important?
Oh, domestic drivers for sure are a lot more important now, because we have to remember China, even though China managed to reach 5% growth last year, it's like only domestic demand is only running at about 3.5 percentage point. Like, almost a third of the growth is really coming from net exports. So again, China does remain very, very competitive in global manufacturing. If you happen to be an ASEAN country that can link vertically in that supply chain, as China gains more market share, I think the only kind of clear winner there is maybe Vietnam. Or if you happen to be in the AI space, which obviously in Asia, that will be Korea, Taiwan, or Singapore, Malaysia, given the shortage of memory chips. But, Philippines is really not part of that ecosystem. Like, Philippines is really not part of that supply chain in any significant way, whether it's AI or kind of a China-based supply chain.
So
again, it
final point, Joe,
Yeah.
now that you mentioned both countries and we're not part of that ecosystem, where are we then in the ASEAN space? Are we like a middling economy?
So, the Philippine story is really about domestic demand. And domestic demand for a while was actually doing relatively okay up until this corruption scandal situation and the uncertainty around that. So really, I think Philippines we need to really watch government spending, because obviously, there's been a bit of obviously a big kind of cutback in the second half of this year. So we really need to watch if government spending starts to pick up a little bit. And then that kind of drives a little bit of a kind of a little bit more confidence on kind of a domestic investment and spending environment, and maybe the lagged impact of kind of lower rates. But yeah, look, on the remittances, that obviously is always a driver, and that has slowed down. We also need to watch very closely to what extent the BPO can continue to be expanding in an environment of AI adoption, also potentially creating some risks of displacement.
All right. Well, thank you so much for your insights. Johanna Chua of Citigroup Global Markets, live from Hong Kong.